Look at the midterms.
It's a midterm election.
It's a real nail biter.
Republicans have improved.
We could hold both of these out.
The stock market is soaring to record levels.
Markets will rise and fall, but this is the United States of America. America.
You might think that the last US presidential election was stolen. Hate the repeal of Roe versus Wade? Worry about what happened in Afghanistan? Or fear this guy might stand again? Let's be honest, you aren't watching this film for political commentary. You want to know how the American midterm elections have affected the stock market. 2022 is a midterm election year, so control of the House of Representatives and the Senate are up for grabs, which means passing legislation and controlling things like tax and spending could get easier or an awful lot harder for this man.
Keep punching at it and punching at it and punching at it.
We'll explain why the market behaves differently in midterm years, what a divided government means for stock prices, and rank presidential market performance in midterm years from best to worst. And if you wanted to see some of our other films we make here at Capital.com, like our recent explainer in investing during high inflation, then click over up here. Before we get started, here's what you need to know about the data we're using. We've analysed the performance of the S&P 500 or US 500, which tracks the 500 biggest companies in America before and after the midterms over the past 50 years. And for this film, we're going to be helped out by this man, Mark Chandler, the Chief Currency Strategist at Bannockburn Global Forex. So let's compare how the market performs in the 12 months before November in midterm and non-midterm years. Investors and businesses tend to favour the familiar. A bit of certainty in an uncertain world goes a long way, which might be why the markets don't like the midterms. Markets increased by an average of 4% in the 12 months before a midterm, but rose over 10% in the 12 months before November when there wasn't a midterm election. Markets want to know if the country is about to change political or economic tack, and there's less certainty about that before the midterms.
So I think that to the extent that we do have political uncertainty in the U.S., whether it's going to be expanding fiscal policy, the kind of appointments we make, the kind of energy policy that we pursue, the big issue headline things that influence the uncertainty among the investor class.
Just after a midterm, the market shifts, and that's because there's more uncertainty behind investors than in front of them. In non-midterm years, markets still made respectable returns in 3, 6 and 12 months after November. But after a midterm election, markets tend to really pick up, increasing by 14% 12 months after polling day. The underlying health of the economy will always influence markets more than politics, but investor confidence in the political outlook still shapes the American stock market. The midterms are an opportunity for voters to tell their leaders they aren't happy, and it turns out voters aren't happy a lot of the time.
If you're not happy here, then you can leave.
In fact, the president's party has lost House seats in 17 of the last 19 midterms, but when voters get especially upset, control of the House of Representatives or the Senate can flip from one party to another. And with almost bipartisan symmetry, one or both houses have flipped 6 times, but also stayed the same 6 times since 1974. But what impact does a flipped house have on the markets? The answer might not be what you'd expect. In the 12 months before a house flip, markets performed nearly 16% better than when neither house changed hands. That means voters don't only give politicians a kick-in if they have less money in their pockets, houses can also flip if voters feel their values are under threat. In 1994, Bill Clinton lost control of both houses, and it wasn't because the economy was in recession. The Republican Party under Newt Gingrich made the argument that American liberalism was morally and ethically corrupt, and voters agreed that the country needed a change of direction.
I see Bill Clinton being able to cooperate with us to get legislation. I do not see him being able to push anything through by himself.
While in the 12 months prior to George W. Bush's second midterm, the Republicans had one of the healthiest economies on record.
Any outlaw regime that has ties to terrorist groups will be confronted.
But voters were worried about the direction of the Iraq War and felt angry about the government's poor response to Hurricane Katrina.
We've seen in the last couple of presidential elections one of the most strongest indicator about the way you would vote is whether an American goes to church on Sundays. Nothing to do about the economy, perhaps. So more about like lifestyle, life choices, values.
After the midterms, the economic picture, well, flips. Once the political posturing has died down, what markets want to see is a bit of peace and calm. After one or both houses flip, the economy makes its highest returns after 6 months before falling back slightly after 12 months. But after a continuity midterm where nothing changes, the market goes from strength to strength, returning almost 19% after 1 year. While voters might turn on politicians for a variety of reasons, markets perform best without political turbulence. You can judge a president using all sorts of metrics, but this film is going by the presidential quote, "It's the economy, stupid." From Gerald Ford to Donald Trump, we're going to see which president got the most out of their economy and the stock market in the months before and after the midterms. In the 12 months prior, last place goes to Gerald Ford and the top spot goes to Ronald Reagan. Gerald Ford came to power months after Richard Nixon's resignation, and the Republican Party took a kicking from voters angry that they'd been lied to. Political turbulence coupled with sky-high inflation and a global oil crisis left the market in the doldrums, while top spot went to Ronald Reagan's second term.
The orderly transfer of authority as called for in the Constitution is nothing less than a miracle.
Reagan had a huge majority, a unified party, a national consumer spending boom, and an economy emerging from a recession. 3 months and 6 months after a midterm, the best and worst performers are the same, so we'll take them together. Returns of -5% and 1.8% in 2002 left George W. Bush in last place, while Bill Clinton took top spot as his economy increased by 16.4% and almost 24% in 1998. George W. Bush became a 2-term president, but that was far from certain in 2002. America was reeling from 9/11, iron military maneuvers in Iraq, and recovering from a burst dot-com bubble. While the Monica Lewinsky scandal may have troubled middle America, it didn't stop Bill Clinton's economy taking top spot in the 3 and 6 months after the midterms.
I did not have sexual relations with that woman, Miss Lewinsky.
In 1999, America thought the dot-com bubble was there to stay, and Bill Clinton held on to both houses the second time of asking. 12 months after a midterm, there was just one president whose economy ended in the red and one outright winner, and both men were Republicans. In last place, on -1.3%, was the darling of the conservative right, Ronald Reagan, after the 1986 midterm, and in top spot, in better news for the Bush dynasty, came George Bush Sr., whose market increased by almost 28%. Ronald Reagan took pride in his low-tax economy, but after a 5-year bull market, it was due a correction.
Today, all around the world, the smart money decided the American economy, American trade, and American interest rates were all in trouble.
And that correction arrived in the shape of Black Monday, as markets fell almost 23% in a day, leaving the actor turned politician in last place.
It's time that some people were reminded that actors are people.
At George Bush Sr.'s midpoint, he looked like a 2-term president. By 1991, the markets were bouncing back strongly from a mild recession. His hopes of re-election, however, ran aground when he didn't read his own lips about no new taxes.
Read my lips. No new taxes.
Finally, let's make ourselves hostage to fortune by looking ahead to November 2022. History tells us that things don't look great for Mr. Biden. The only president since the Second World War to pick up seats in both houses was this man. But since the war, presidents have lost on average 23 House seats per midterm. The bad news for Biden is that there are just 1 or 2 blips on the economic horizon.
COVID-19, brutal, needless war, inflation.
The better news for Biden is, as we've seen, voters don't only care about the economy. The 3 presidents with the worst performing economies 12 months before a midterm were Ford, Bush Sr. and Bush Jr., and all 3 kept control of both houses. Even if the Democrats lose out in the 2022 midterms, it doesn't mean that the party won't bounce back and win the presidency in 2024.
Bill Clinton and Barack Obama lost control of one or both houses, and both went on to become two-term presidents.
There was only one man who suffered a house flip who was a one-term president, and that's this guy. And in the end, the 2022 midterm might be about as much about the guy on the right as the guy on the left. Thanks for watching. Remember that the price of stocks and shares may vary depending on changing market conditions, and don't forget to subscribe to stay alerted to our regular chart analysis videos each week and other explainers on the big financial topics of the day.